All righty, ready, set, go. Here we are. Hey there, Rockstar. How are you? Good to see you. Welcome to the Epic Real Estate Investing Show, where we show people how to invest in real estate so they can retire early. All right, so I'm not buying real estate anymore because the rates are too high and the market it's about to crash. That is a message that we just got from a cash flow savvy buyer yesterday. And Cash Flow Savvy is the service that we've been operating for more than a decade now, where we show busy professionals how to build a real estate portfolio in their spare time so they can retire early, so they can escape that daily grind. And that was a message we got. And it was based off of the news that we're seeing in the market, very much like this, right? This was just yesterday. Mortgage rates reach highest since August 2007. And that can be concerning, particularly when it's called Cash Flow Savvy. And we pride ourselves on producing cash flow, which we are still doing. But the more and more that they raise the interest rates, it gets a little bit more difficult because that payment rises, right? So let's see what I had right here. This article, I had it all highlighted and my highlights just disappeared. Let's see. That's always great once it's showtime, right? Okay, let's see. Mortgage rates right here. Mortgage rates moved higher again this week, with the 30-year fixed rate averaging 6.29%, up from 6.02% last week. And a year ago this time, the 30-year rate was 2.88%. So that's like a little bit more than doubled. And then let's see. The housing market continues to face headwinds as mortgage rates increase again this week. And then right here, higher rates, housing prices are softening, and home sales have decreased. However, the number of homes for sale remains well below normal. So certainly there's a lot of cause for alarm, so to speak, inside of the market is doing as far as it pertains to mortgage rates. But there's this here. We're going to get back to that in a second about the number of homes for sale, how it remains low. Next is, where is it going, though? So we know where it's at. So should we wait or should we continue? Is the market going to crash? What's going to happen? So the Fed is dead set on bringing down inflation. Markets be damned, they say. So what happens next? The median end 2023 projection was lifted by 80 basis points to 4.6%, while the end 2024 projection was increased 50 basis points. So basically that means we're expecting rates to continue to rise through 2024. Those are the projections. And in his press conference, Powell emphasized that he wanted to see positive real interest rates that is above the rate of inflation. Now, if you don't know what that means, that's a very important, you should be factoring into your decision making, and I'll talk about that in just a second. But this cash flow savvy buyer, this is a very understandable position, right? But consider it might be a naive and losing position when considering really the big picture. And in the big picture, it's going to require you to think differently than you've probably thought in the past. You know, we're headed into uncharted waters, and I'll explain. The market, it's indeed shifting. We all see it. We can all feel it, right? And it is prudent to take these mortgage rates and this type of stuff into consideration regarding your investment decisions, particularly if you're cash flow investors like we are here. Yet the entire economy is shifting. And that's something that we want to look at a little bit more closely, because it's becoming more and more of an emotional thing for people. And they're making emotional decisions. And we have to try to be very careful when our emotions are involved in our investment decision process, especially when it comes to things like investing, right? There's no room for emotions in investing. It's just based on supply, demand, and basic math. And they say when emotions rise, intelligence falls. And we're seeing that right now in the marketplace. And I'm going to show you some intelligent options here in a minute. And I'm going to show you a house that I just picked up for free. Those are coming more and more available. That opportunity is presenting itself more frequently right now. And then I'm going to show you another house that I own. I've owned it for a while, and a tenant just moved out and they completely wrecked it. And that would typically be a bad thing by most people's standards. But I'm going to share with you why this is quite the opposite for me. And I'll show you why I'll show you the other part. Right. So I'm going to show you the lesson that I learned, but I got some notes here just to make sure I don't forget anything. But your decisions right now should not be based on just the housing market, but on the economy overall, because in a rigged system that is designed to steal your money, if you are positioned correctly, you can actually use it against itself to make you very, very wealthy. But you just got to think different, and that than you're probably used to. And it really all just boils down to understanding how money really works. And I just finished a new report here on this very thing. It's the 7 imminent threats to your American dream and the single action that you can take to neutralize them all before. And I would recommend that everybody read this before making that next investment, because it's going to give you the insight to what there is to think about. And if you like a copy, I made it really easy for you, and I uploaded it over there at epicfreedombook.com, and you'll see the link there on the screen, and you'll see the link down below in the description. And if you're listening on the podcast, it's epicfreedombook.com, epicfreedombook.com. Alrighty, so let's take a look at our intelligent options. And because we could go into the stock market, right? We could do that, but we know what that's doing over the last year. Let me see if I can make this a little bit bigger so I can see the whole thing. There we go. All right, so we know what the stock market is doing. It's not doing great. It's down. And then we know if you're into crypto, which I am, and it upsets some of my friends, but I am. But it's down, right? So there's the year, what that looks like. And then, what everyone wants to buy during inflation is gold, right? Well, believe it or not, gold is down, as we can see right here. So that's what the gold line looks like for a year. And then if you're listening to the news at all, you know that the existing home sales are down as well. So that's what it looks like for this year. Not too encouraging, and it would look like bad news. Then if we look at those are existing home sales, look at the new home sales. What do those look like? Well, this is for the lifetime. Let me put this on for the year. So not too much differently than the existing home sales, right? Home sales are down, and this is kind of what the news is really focusing on. Now, then they're also focusing on the housing inventory, how it's starting to rise a little bit. And that has people concerned for a crash. Understandably, because if there's more supply than demand, that could be a precondition for a crash. And the housing bubble is about to pop, is what people are thinking. And historically, during tough economic times, that would be reasonable logic. However, historically, inventory didn't look like this. So if we just have this narrow snapshot of what the year looks like, well, let's look at the 5-year. Oh, it doesn't expand more. Okay, I got the wrong chart. Well, but we are still historically low. So this goes back from 2016. Okay, yeah, no, it did. It just didn't change. It didn't look too much differently. All right, so this is back from 2016 where inventory was extremely high. And here we are, what's that? 6 years later, still very, very low. Not necessarily a precondition for a crash, okay? But here's the other thing that's in play right now. Historically, we haven't had, let me get rid of these pages so they don't stop coming up. All right. Historically, we haven't had inflation look like this. I mean, look at this. This is just inflation going up and up and up. And this has got everybody's attention. We see it at the gas pump. We see it in the grocery store and our energy bills. And we just haven't had it like this. So we have kind of some different things that are playing right now that give us different things to think about other than just rising mortgage rates. And we'll get back to that in a second. So if all of your traditional investments are suffering and inflation is eating up the value of your money, what do? What do you turn to? So the average person that's on either a fixed income or living off a single salary, they're in trouble. They're in a lot of trouble unless they reposition themselves and quickly. And for many more reasons than I've stated here so far, they're all in that report, by the way. The one I just finished, I was telling you about, and I uploaded it there for you at epicfreedombook.com. And it is free, by the way, totally free. But the positioning I'm talking about here is, there we go. I'm playing producer and talent, and I say that all the time, but boy, I think I'm going to get better and better at it, but it's still kind of cumbersome operating on this small little screen. But the position that I'm talking about, despite what you may be feeling is the right thing to do, it begins with using other people's money. to purchase income producing real estate. That is something that we can all do that can put us on the right side of this thing. And for many more reasons, or for many reasons of which I'm going to give you. But one of the more important reasons is what the media is not focusing on. Yet the right here, yet the although the what do you call it? The sales are slowing, right? But look what the prices are doing, right? So that's for lifetime. But let's just look at this year. So although the sales are dropping, but the prices are not, right? So we want to look at that, and if we teeter back and forth between let's see. Oh, I just deleted the inflation one. But you saw the inflation on its regular rise. And it looks very much, the housing appreciation rate and the inflation rate look very, very similar. And that would be one of the reasons that you'd want to be involved in real estate, right? Is the hedge against inflation. The money that you have invested in real estate is protected from inflation. Most people are in the most aggressive inflationary times of their lives. A lot of us have never seen anything like this, which reinforces the case for real estate. Then reason number 2 would be when you borrow someone else's money to purchase your real estate, you multiply your return by a factor of 5. Most people put down 20% to buy 100% of the asset. And so that multiplies your return by 5. And that really doesn't exist in any other asset class that's really available to the average person. A lot of people, they say, yeah, we can leverage stocks and stuff like that, but that takes a very skilled person to do it safely, and even if it is safe there. But the other thing that leverage allows you to do is it allows you to take full benefit of the entire use of the asset. So you get benefit of the depreciation, you get benefit of the appreciation, of course, you get benefit of the income, you get benefit of the amortization, you get benefit of the use of the property. So leverage is a lot more than just maximizing your ROI. It's maximizing your use of it as well. Then third thing would be when you borrow someone else's money is inflation. It destroys the debt. We call that debt destruction. And I'll always give credit to Mr. Jason Hartman, who kind of turned me onto this a few years ago. And it's so true because the inflation, it's an equal opportunity destroyer. It destroys your money as much as it destroys the bank's money. So if that's the case, do you want it to destroy your money, or would you rather have it destroy the bank's money? So use the bank's money to purchase your income producing asset, meaning your debt payment is going to remain the same over time. But because of inflation, you're going to be paid more dollars in the future, whether that's through your job or your business. And what that's going to allow you to do is you're getting paid more and more in the future because of inflation. It makes it easier and easier for you to manage the debt that was basically had a snapshot in the past. Okay. Then reason number 4, the mortgage rates are low. And I know some people might be going, what? I just thought the mortgage rates went up and up and up. And this is going to directly address our cash flow savvy clients' concern that mortgage rates are low from 3 perspectives. Okay. First, historically speaking, if I come over here to that and kind of put that up there, can you all see that? There you go. Is that the mortgage rate? Yeah, so this is what it looks like this year. So it looks like it's really, really high, right? Like, wow, look at the mortgage rates are going way up. But if we do it and look and kind of zoom out and look at the entire history of it, we're still extremely, extremely low. Okay. So the mortgage rates are low from that perspective. The second thing that they are low, the second reason that they were low, is it's a very rare occasion that interest rates are lower than the inflation rate. So the CPI right now is things at 8.5%, and the mortgage rates are right around 6-ish. And that's an effective interest rate of a negative 2.5%. So despite what the economy is doing, and it all seems bad, the economy is still paying you to borrow money. You are getting paid to use up somebody else's money because of inflation, and that inflation number being higher than the mortgage rate right now. And the third reason is that rates are low And the consensus is that rates will continue to rise for a while. I just read that to you right at the top. And whether that happens fast or slow, I don't know, but they will go up for a while before they come down or before they even settle. So you want to kind of consider, like, the timing wise, if you want to wait to buy real estate, you might be waiting a couple years. And I mean, just think about right now. Don't you wish you would have bought some just 6 months ago when the rates were really low, and then 6 months before that? So the thing you got to think about is when it's already essentially guaranteed or projected by those in the know that we are going to continue raising rates. So what are you going to say 6 months from now? Are you going to wish you bought today? Okay, so think about all those. There's 3 reasons that the rates are still very, very low. And so reason number 5 here. All right, I will get better at this. It's like playing a musical instrument. The tax benefits. Now, it's no secret that the Biden administration is making a big push toward tax reform and tax collection enforcement. We all heard about the big number. I think it was 86,000 new IRS agents they are hiring. And they say they're only coming after the rich. But you know, there's only 600 billionaires in the United States. And they don't need 87,000 agents to go over after 600 people, right? And I don't know if you saw, but the Republicans, and this is not a political conversation, this is just what's going on. As investors, we got to pay attention to what the numbers and what the policy is doing. But the Republicans asked the Democrats to sign an amendment ensuring that those enforcement agents wouldn't go after people making less than $400,000 a year. Because that was the big push. Is Biden himself says this is only going to impact people that earn over $400,000 a year. And the Republicans were like, okay, well, that's fine. We'll go after the big people. We're on board with that. But let's go ahead and add an amendment that we won't go after the little guy. And the Democrats unanimously would not sign it. So I'm just kind of putting those things together that maybe they're not going after just the rich. Maybe they got their eye on the upper middle class, the middle class, and everybody else, right? So just consider that. But real estate, it's the most tax-favored asset class available to the average person. And you get those tax benefits through business ownership, because once you own an income property, you classify as a business, so you can go ahead and write off all of those, all your normal bills that you're already paying, like your phone bill and your internet, and maybe your home office, stuff like that. And then you also get tax deductions from the property depreciation. The IRS code gives you an allowance for the normal wear and tear on your property. And then the other area where it's really big is the interest rate, right? Is the mortgage interest deduction. And effectively, so if you are paying, say, $1,000 in interest, because of the tax benefits, you're really only paying maybe, I don't know, $600 or $700 in interest, depending on your tax bracket. So there's a big benefit there as well. All right, and then so reason number 6, I always move fast to the taxes. I'm not a tax attorney. That's kind of a boring topic because you don't really see money coming in, and I think people kind of ignore that and they don't give it much attention. But tax planning can go so far for you. It's not money that's necessarily going to come into you, but it's money that's not, you're not going to have to write that check to Uncle Sam. And that always feels good when that check is smaller and smaller and smaller, but we never really feel it because, you know, that money doesn't seem real. It's like, well, it was my money anyway, so I get to keep it. So it doesn't feel like a profit center of real estate, but it absolutely is. It's a huge one. Okay, so don't discredit that. Next thing is, where is this? Number 6, appreciation. And this, you know, appreciation, I always consider that it's the icing on the cake for real estate. And that's what most people focus on, is the appreciation. Like, is this a good time to get in real estate? Am I buying low enough? Is it going to be worth more next year? That's what everyone's always kind of focused on. But it could be now, though, this could be the cake here into the long and foreseeable future. And that's based on something that the rigged system can't manipulate, nor really can the Fed or the monetary policy. And what I'm talking about is the natural organic supply and demand. Now, I already showed you how the housing supply is very, very low, right? Let's get rid of them, these here. And then here they are for the housing starts. So this is just this year. And it's kind of up and down, mostly down right now, but it looks like it took a little tick uptick for the upside here in August. But let's look at historically speaking why this is a really big deal. So these are the housing starts. Okay, so this is the new home builders, how many new homes they're building. And it was right about here at the peak of 2006, right? 2007 when the market crashed and we entered the Great Recession. And then builders, they got knocked out and they just stopped building houses all the way down here. A lot of them left the business. And then those that stayed in the business, you can see they really entered the market very gingerly and cautiously. You can see that, right? And so here we are all the way up here, and we came up a little bit. We got a little excited, and then we're back down here. And this is a big deal because we really needed, with the number of people that we have, we needed to stay right here at this peak, and we needed to maintain this all the way along to have enough houses for what we got for the number of people that we have today. So we had this huge deficit. I'll show you. Let me look this up real quick. This is a population by age. It's a good stat, and this is going to give you a good insight as to whether the problem is. Here it is. So this right here, let me see if I click on that. Will it give me the big picture? Let's see. Here it is. So this chart right there, can you guys see that? Yes, you can. So this chart right here, this represents where our population is, how they're distributed amongst age. So if we look at this orangish yellow section here, here's the millennials. And right here is where we are with age 31, 29, 30, is right where the peak of, here's the peak, age 28, 29, 30 of the millennials. The average age of the first-time home buyer is 34 years old. So what that says is over the next, 3, 6, maybe 8 years at least, we might see some bumps in the road, but this demand for housing, it can't be held back forever. The demand is coming. People need a place to live. And when this economy settles, this demand is going to snap like a rubber band. So you want to be owning some real estate when that happens. Obviously, I think that the more that you own, the better off you're going to be. We might have some bumps in the road, and it might be kind of crazy for a little while. So I'm not going to say overindulge and be irresponsible about it. But this thing is going to snap back unless, people stop wanting to live in houses, right? I mean, that's really all it is. And so this might be a really good time to buy real estate. Now, we are seeing some homeowners experiencing some difficulty, like with this house right here. I just got this one. Let me clear some of this off. There we go. All right, so I just bought this house, and I got this one for free. And it doesn't look great, right? It's on a very nice street. You can't really tell by that picture. But the owner was like, I can't make the payments anymore. He just said, take over the payments and you can have it. So I'm going to be fixing it up, and it's going to be great. And I'll show you why. And it's just a little 1-bedroom place. So it doesn't look like much. And it looks like it needs a lot of work. But I'm going to show you a little bit of why I'm excited about this one. And then there's this house that I actually bought this at the beginning of the pandemic. You can see the little watermark there. I got this off of my property manager's website. But I bought this with seller financing. And this place recently was just trashed by the tenant when they moved out earlier this year. Enough so that it might cause the average person to sell it, to throw in the towel and say, I don't want to do this anymore, and move on from real estate investments altogether. But here's why that's not even remotely a consideration for me. First, because of the everything that I've already mentioned, right? I mean, real estate is where you got to be positioned right now. Second, with inventory so low, you don't want to bail on good properties like this that are in great neighborhoods just because of one bad experience. You don't want to walk away with the wrong lesson and give up the most stable position that you could be in right now. And third, that would bring me to, where is it? Right there. Number 7 would be the purchasing of the income producing real estate is that the rents are surging. Rents are up. Let me show you. There's that. There's the home price national index, newly home prices, housing starts, and right there's the one I'm looking for right here. So U.S. rent surge. And if we go in and look at the details here from Realtor.com, you can see selling sentiment declined and listing activity followed. with newly declining by 13.4% year over year. Wrong report. It's this one here. All right. So August 2022 makes the first month in the past 13 months where rent growth has slowed to a single-digit rate for 0 to 2 bedroom properties. Okay. But it's slowed to a rate of 9.8%. Keep that number in mind right there, that 9.8%. But here's why I'm excited right now. Studios continue to catch up with double-digit rent increases, whereas 1 to 2 bedroom units experienced single-digit growth. So this property that I just showed you, it's effectively a studio, and rents are surging for that right now because people can't even afford the 1 to 2 to 3 bedrooms. So those are slowing down the demand. The demand has shifted from the housing buying market over to the housing renting market. And so this 9.8%, if we look at the actual year over year on home sales, appreciation is 6.9%. So this is going to be something very significant. But this right here, this 9.8%. So this house that I purchased, that I'm repairing, where is it? There it is. I borrowed the money to get it repaired. It was about 25 grand, and that raised my debt service on this property by just 5%. But 6 new tenant applications came in this week for a rent increase of 21%. So my debt service was raised 6%, but my rent increase was 21%. See, the home value is pacing inflation, and rents are now outpacing it. So that's the question to ask yourself, especially if you have any reluctance to be a landlord. You can either choose to figure it out and collect rising rents or not, and pay rising rents, right? So if you'd rather receive rents more than you'd rather pay them, then just let me know by hitting that little like button. Appreciate that from you. But housing prices are up, but not as fast as the rents are, as I just showed you. So this isn't greedy landlord stuff, right? There's a lot of people that will say it is. We see this in the news and the media. We're seeing it everywhere that these greedy landlords they're stealing from their tenants and they're being really mean. But it's an economy thing. The market is doing what the market does, and so it's no more complicated than supply and demand. What's causing rents to climb is the same thing that's causing gas, food, and energy to climb. Anyway, 2 things going on in the housing market right now that are very rare and present an opportunity, and even more rare to be happening at the same time. And it's an opportunity here with the interest rates being lower than the inflation rate. The inflation rate higher than the interest rate, which creates a negative interest rate. The economy is paying you to borrow money. And if you borrow that money to buy an asset that only appreciates with inflation, it will not only in the value, but also in the income it produces, that's a huge opportunity. And now the rents are now rising faster than housing prices. I went back and looked, and I don't know if I couldn't find anywhere in history where rents actually outpaced the value of the houses. So before you make any hasty decisions about investing or not to, remove your emotions from it and just consider the bigger picture at play right now. We're dealing with an entirely different animal than a lot of us have ever experienced. And if you have any ideas about a better investment, if you think I'm just, full of hot air and you got something better than real estate, then something that checks all of these boxes of all these things that we're dealing with, then go ahead and put it in the comments. Like if you got another one that's going to hedge against inflation, and one where you can use leverage, where you can use leverage and have the inflation destroy that debt, where you've got a low mortgage rate historically or a low borrowing rate, where you've got the same tax benefits, where you have almost guaranteed appreciation over the next decade, and where you've got it's increasing income is rising and rising and rising. If you've got another investment that does all of that, then let me know down below in the comments, because I would love to know. Because if there is, I'll throw some money that way too. I'd love to give that my attention. But do yourself a favor. This is really, really important right now. Do yourself a favor and just to see what you're up against. And I put it all down in great detail and made it available for you. I uploaded it nice and conveniently for you over at epicfreedombook.com. All right, epicfreedombook.com. If you got any questions, I see some chats coming over here, so I'm going to check them out. Haven't looked at them the whole time, so here we are. Let me catch up and I'll answer some questions. All right. Good evening, Kevin from Lakeland, Florida. good to see you. Is this really live right now? Yes, it's really live right now. But prices shot way up from 2020 to 2022. Yes, they did, Matt. They did shoot way up, and they are continuing to go up. They have not settled back down. You're seeing listing prices come down, but you're not seeing the sales price come down yet. People can't afford houses at the moment. This is very, very true. So they are renting. So this is a good place to be. You want to look at what the economy is doing and put yourself on the right side. It's really just all about positioning. And let's see, Matt asked me, what's your thought of the inventory going up from 2,500 to 12,000 over 3 months in Vegas? If that trend continues over winter, that's a lot of inventory. Yeah, it could be. I'm making a lot of offers here in Vegas, and the sellers aren't hip to it yet. So we're going to see. I'm keeping my eye on it because I live here, right? And hello to you. All right. So good to be with you guys today. That's all I got for right now. Health, peace, blessings, and abundance to you. Have a great weekend, and don't be fooled by the media. Pay attention to what's really, really going on. And go grab that book, epicfreedombook.com, and that'll get you positioned right to win. You can take this rigged system. It's designed to steal your money, and you can use it against itself to actually make yourself more wealthy than you could in an up market. All right. Last question here before we sign off. Ricardo, will you be doing any challenges in the near future? Absolutely. I'm seeing the fall for the next challenge. So stay tuned. And thanks for asking. I appreciate you.